I'm going to allocate that we're going to allocate our dollars. We're going to beat whatever an index can provide, and we can go on our merry way. But what we find, unfortunately, is that beating the market is really, really hard to do. And so, hold on here. Just click in here so I can advance the slides.
Yeah,
There we go.
got it. It's showing up on
Oh,
the screen
yeah.
there.
We'll work through a little. There we go. Okay, perfect. Perfect. Okay, so this the date on these two images are a little few years old, but they serve the purpose in the sense that the top chart shows various returns that we see in the market. Way over on the left-hand side is what we can find in REITs, and this is for a 20-year period, 1997 through 2016. And you can see if you invested in real estate, you would have earned about slightly under 10% on an annualized basis. And you can see as we lockstep down from the left to the right, all the way over to inflation, which is 2%. And just to the left of inflation is the average investor, barely exceeding inflation. And had the average investor instead just invested in the S&P 500 or just 60% stock, 40% bond portfolio, they would have done much, much better. The bottom chart is from a firm called Delbar out of Massachusetts. And what they look at is, what does the average equity investor, what's the average investor who just goes into the stock market, what type of returns did they get? Same time period, 20 years ending in 2016, and they had 4.8%, which again is a little bit above inflation, but about 3% less than had they just bought the Vanguard S&P 500 index fund and then went off having fun doing whatever hobbies and interests that a person has. So why is that? Why is the average investor that far behind just what the market would deliver? And that's where the behavior gap comes into play. And so Carl Richards, who's kind of one of the advisors, kind of coined this phrase of, why do people make the decisions that they make that prevents them from just getting market returns? Some of the reasons would be is just the way that we're wired, right? The way that we make decisions. And this is where our friends in psychology comes in so much. We learn so much about human decision making. So within investing, there's things like following the herd, right? We have this tendency where people where people will sell at market bottoms and then will buy really aggressively at market highs. Okay, they'll hear everyone's buying EV or everyone is buying Bitcoin and it's driving prices up. There's a tendency to chase hot stocks, hot funds, things that are getting talked about in CNBC. We know that people trade too much, and as technology and information flows, we see that the average investor trades and trades and trades, which unfortunately will benefit those that are just executing the trades on our behalf. And finally, we know that we just, as a whole, as average Americans, have a tendency of just saving too little. Okay. If we go beyond, what are the underlying behaviors that kind of drives this? So Ben Graham, legendary value investor, we kind of call him the father of value investing. He was Warren Buffett's teacher at Columbia. Ben Graham has said that the investor's chief problem, and even their worst enemy, is likely to be themselves. Okay, and sometimes staring ourselves in the mirror and looking in the mirror and seeing what kind of decisions we make can sometimes explain this. So when we think about what are some of these kind of innate types of things that will make us make decisions, would be things like we are wired as an instinct to eliminate pain. Okay, I always kind of describe to students is that when we put our hand on a hot stove, we don't have to actually start thinking, wow, that feels hot. Let me think and move my hand away, right? It's an automatic reflex. And we're the same way with markets. We are overconfident. Okay, overconfidence serves us well in so many things in life, but with the market, sometimes this overconfidence will lead us to thinking that we can beat the market. That there's greed and fear, and there's finally this urge to do something. Especially, we see this really getting amplified when the markets are usually dropping. Usually, when they're going up, people are feeling well. It's usually when we see these market drops. We already experienced a little bit of it this year. The Dow was down just a little bit, about 10%. So we got into this correction, and already this was starting to amplify, even though markets have been doing so well for a while. when I talk to my wealth management students, most of them don't appreciate this because with the blip at the beginning of COVID and maybe what we experienced earlier this year, any young person really hasn't experienced a real market calamity. So when I try to explain to them, like I started my wealth management career between the 2002 bear market, or we all remember 2008, how that felt, that to a young person, they don't know. So you have to try to illustrate this and hopefully, hey, when your turn comes, hopefully you make good decisions with it. But if we look at the cycle of emotions, which was a very valuable chart that I used to use back in the day when I used to work with clients, that if we look at as we look at the line, let's say, or this curve illustrating the markets, right? When the markets go up and up and up, you can see some of these descriptions: optimistic, excited, elated, right? When the markets are at all-time high, then things turn down, markets turn down, and you can see we start getting concerned, nervous, alarmed, frightened. And so, those of us that have had some history on our side, we can kind of relive different periods. And I can still remember sitting in my office taking calls from clients, first quarter 2009, trying to reassure people things are going to be all right, and getting off the phone going, please, we're going to have an economy tomorrow, right? And so, but the thing though that's interesting is that at the point when markets are at highs, or at the point when markets are at lows, our friends really don't help because they're pushing messaging to us, right? When markets are at all-time high, we get these Fortune cover stories or CNBC, advertisements about we can retire rich and live on the beaches. And then when the markets are at lows, it's like, things are never coming back. And the magazine cover, the Newsweek 1978, The Death of Equities, which is probably the all-time poster child of, the death of equities, and then we know for the next 20 years how well they've done. Whoops, got that one wrong. So that doesn't help us, right? So in a way, the media is amplifying what we should be feeling. And so the last thing I'll leave here is that Warren Buffett, the great Warren Buffett as an investor, many characteristics, but he will even say his number one superpower is that when the markets are at high, when greed is running, is when he gets fearful. And when on the flip side, when the markets are in lows and everyone is freaking out, is when he gets greedy. It's so counter that most of us can't do that, right? And I guess that's why Warren Buffett's Warren Buffett, but still understanding the emotions we go through is very important. Now, in finance, okay, and again, taking a lot of the work from our friends in economics, traditional finance has some basic underlying assumptions to make all of the formulas work. One is that we have efficient markets, that markets totally reflect all the information that is out there. Prices are fair, they're the best proxy for value, and that it's very, very difficult to beat the markets. Okay, that's premise number one. Number two, all investors are rational, right? That we all make perfectly rational decisions. And three, we all have the same interests. We're all homogenous. And you can see though that when the behavioral people start looking at it going, we can see some holes in this, right? Mm-hmm. And I can tell you from friends, I have lots of friends that are far from rational when it comes to investing, right? And we all have different interests. And so that's where, is there some ways that we can look at things a little bit different? When we think about, traditional investing, we do have giants in the field that we kind of build off from. And their work is really important. And so, Milton Friedman, Nobel Prize winner, economics, came up with this idea of how we control the money supply, helps us understand inflation. Harry Markowitz won a Nobel Prize for explaining how do we rationally put portfolios together. We can mathematically be real precise with it. Eugene Fama, University of Chicago, Nobel Prize winner, efficient market hypothesis. And then coincidentally enough, the year he won the Nobel Prize, and I think it was the Nobel Committee kind of making a little joke, is that it was kind of the father of efficient markets. Then Bob Shiller won the Nobel Prize as one of the first behavioral finance people. And so in a way, do we really understand this quite yet? And then Bill Sharp, who won a Nobel Prize for the CAPM model that we use all the time in finance, but it's all based on these assumptions that we're all rational, we're all homogenous, we all have the same interests. And the behavioral finance people, that kind of comes, and again, our formulas that we all love in finance, but it's kind of our friends from psychology that says, we got to take the human We got to keep the decision making that we have. And this might help explain why we really don't do and behave way that I guess the traditional economists or traditional finance people would think that we should be. And so I've been really, really fascinated. So back in the day when I had clients and helping them build portfolios and make good decisions with their money, when I first was learning about behavioral finance or behavioral economics, depending on who's kind of writing it, my initial thought was, this is going to be great because now I'm going to be able to help my clients almost like treat them, right? Help them change. And then I quickly realized that's not what this is about. This is more about identifying, we all have these little quirks, and now how can I identify them in my clients and then maybe change the way that I explain something or position something or structure so that we can counter some of these. And it really interferes with all of the important decisions that we have kind of in financial planning, let's say, or in investment management, like decisions about how do we spend, how do we invest, how do we borrow, how do we save? So it has impact on all this. And so the ones that I kind of want to walk through, and again, there's many of these, we'll call them either biases or emotional traits. There's a book that I read where there's like 50 or 60 of them. We won't go through all those, but we'll just hit like the big 5, okay? And just to kind of illustrate some of these emotional biases, some of you may recognize these, like, oh yeah, I can picture myself doing this, or others like, why would anyone fall prey to this? So first one would be mental accounting. Okay, mental accounting. So what is mental accounting? Mental accounting basically is how we categorize dollars that we have differently. We kind of bucket things. And so Homer Simpson here, you can see how he kind of buckets things in his mind of where resources should be. And if we think about it, like how many of us have been to a casino and we bring in $100 and we're at a hot streak and now we have 200. Do we treat the second $100 differently? Do we invest or do we gamble different? Is our decision making different with house money versus our money? Okay. If we get a tax return money back, do we treat that money different than maybe what we would have from whatever our source of income, as our pensions, our Social Security, our salaries, whatever the case might be? If we receive a bonus from work or a gift from a friend or family or an inheritance, do we treat that money differently? We shouldn't, right? Money is money, green is green, but we do have this tendencies of some things are all of a sudden like, hey, I'm gonna go splurge on it because I got my big tax return in. Why is it? Because mental accounting helps us understand it. So we can see some of this come into play where some people will have money in their savings account, which today is earning what? Just about this, the big O zero, maybe with a few, hundreds of a percentage point. And then they'll carry credit card balance. And credit cards have an interest rate of what, like 18, 20%. Why? Well, some people are like, hey, my savings is my savings and my borrowings. And yet if you're like, does that make sense? Maybe there's a rational reason for it, but oftentimes it's like, what, that's savings, that's borrowing. But yet if we treat it all the same, we would just move it from savings, pay off the credit card. That's a pretty good return on my money. When people will have a tendency of spending differently because we're swiping a credit card versus cash. And this one over time gets weaker and weaker because we're so plastic oriented. But even 10 years ago where I was like, oh, do I want to use, because anymore now, I really don't have the option of using cash because I usually have like $1 in my wallet if I'm lucky. But again, because of the fact I don't have to worry about it for another 30 days until the credit card, would I buy things that I wouldn't, where if I had to literally peel off 3, 4 20s, we might be a little more reluctant. Yeah, we can probably all see examples of that. And so an example that comes in would be like this little exercise. So let's imagine that you bought a ticket to the Rose Bowl. Okay, so at the stadium, you're walking in and you realize you lost the ticket. Okay, and the ticket had cost $150. Do you spend another $150 just to go see the game? Okay, so we think about that scenario. Second scenario is that we haven't bought the ticket yet. We have a $300. We know it's going to cost us $150, but we lose $150. Now I got 150 left. Do you buy the ticket? Now, when psychologists have run these studies, what they have found is that people are more reluctant in the first scenario to then go buy the ticket than in the second. Why? Because in the second example, it's all money, right? Okay, well, the 150, I just lost money, I didn't lose the ticket. As soon as they buy the ticket, it's like, I'm not gonna replace the ticket. But if you think about this rationally, it's still gonna cost you $300, but there is differences. So it is kind of interesting where mental accounting will prevent us from making what maybe mathematically seems like the same type of cost. Another one, this would be just an example of shortcuts. And we do find ourselves doing this all the time, is that in a lake, there's a patch of lily pads. Every day the patch doubles in size. It takes 48 days for the patch to cover the entire lake. How long does it take for the patch just to cover half the lake? Okay, so what's the answer? It's 47 days. But I don't know if you're like me, the first time I read it, oh, that's easy, 24. Yep. I mean, come on, I don't even need a calculator to solve that one. It's like, whoops, okay, my shortcut then kind of, caused me an issue. So what are some strategies that we can use to overcome this? One, imagine a world without plastic. Okay, again, to my kids, to my students, oftentimes they're like, what? There was a world before plastic? But yeah, how would I make buy decisions if we just had to pay cash for something? Another one would be hurry up and wait, which would be like when the tax return money comes in, or a bonus comes in, or some extra or outside the ordinary money comes in. We wait for a little bit so that it just kind of like gathers and mixes with our normal. Then our spending decisions might be a little bit different. And then just again, imagine all income is the same. Okay, so we don't compartmentalize it. So I guess I'll just pause there real quick. Any questions on that one or anything up to this point?
We tend to take questions at the end.
That's cool.
Just so
Yep.
you know.
Yep, we can do
And
that.
then they'll come in on the chat and Emily
Okay.
will monitor that.
Awesome. Okay, we can continue on. The second one would be a behavioral bias called loss aversion. So it's kind of what exactly is loss aversion? One would be, how do we react when we see gains and we have losses? And so Carl Richards, again, he's kind of known as the napkin drawer. He was an advisor that would try to illustrate points to his clients and would put it little sketches. Then he morphed this into a New York Times weekly article, and now is like one of the proverbial consultants in the industry. He drew this one, which is, there was a couple of Israeli psychologists, Amos Tversky, Danny Kahneman, and they did research on decision making. And what they found is that we get a sense that the pleasure of a gain is only worth about half of the pain from loss. Okay, and so we think about, so the number is like 2.2. I don't know how they got the precision of 2.2, but it would be like, hey, if I can get $1 for the feeling of pleasure from the gain, it's really going to be 2.2 times that from when I experience this from a loss. And so what does this mean? What this means is that when if I have a trade that works out, or I buy a stock, or I have an investment that plays out versus one that has a loss, that loss feels so much worse. And so the implications is that what happens? We will sell our winners, we let our losers hang on because we don't want to experience that loss. And that we do have a tendency sometimes of taking money out of the market when things are starting to not really, feel as good for us. And from an academic standpoint, I always can share this with my students, is that we get these things called SIRs at the end of the year. The students get to saying, hey, was this a good class or bad class? And they'll write comments down, and I'll get my SIRs and I'll look through them, and I will have oh, good professor, blah, blah, blah. And there's one that will have something that's negative. That negative one will just drive, that was like, what? And sometimes it's if it's feedback, oh, that's good feedback. But if it's this professor is a joke, what's he doing? And it's I'll have 10 great ones, that one will just stick with me. And then I'm like, oh, that's called prospect theory. The pain of that one negative comment. It's yeah, I think we've all experienced situations like that. And so one way of kind of thinking through this would be, let's think that there was a scenario that on the way in, before being able to sit down, I said, okay, tell you what, we're going to flip a coin. Or first, you can walk through, I'll give you $50, or we'll flip a coin. And if it's heads, you get 100. If it's tails, you just sit down with nothing. Okay, so think about, okay, which way am I going to choose on this? The second scenario is this one. that on the way in, that you pay me 50 bucks. Or if you're like, I'm not gonna pay you 50 bucks, we flip a coin, and if it's heads, you pay me 100, or if it's tails, you will sit down. Which way are we gonna go? Now, if we think about this mathematically, it's the same payoff, right? So if you're a risk taker, you're gonna choose B and D. If you're not really a risk taker, you're just gonna say, I'm gonna pick A or C. But what do we see when we really do this as an experiment? Most people are gonna choose A, they're gonna choose D, which runs contrary to what it would be like if it's just regular, like a traditional economics or finance person would never, just because of how we judge, the pain of loss and the decisions we would make as a result of it. And so what are the strategies that we can overcome this? This is looking at it from, let's say, how do I implement this with clients? One is to diversify. Okay, if we know we're going to agonize over having a stock in the portfolio that's going to do really, inevitably one's going to do bad, how do I get around it? Diversify. Have lots of investments that kind of like will, smooth out some of those rough spots. Focus on the big picture, where you would say, let's look at the overall portfolio. There's going to be times where certain assets are going to do really well. There's times certain assets are going to do really poor. But if we look at the big picture, how does the entire portfolio play out? That's one way from us of not being as worried about the components of it. And really the last way would be is if there's individual stocks that have done poorly, would be I can just reframe it as like, oh, let's look at that loss as a gain. I can sell it off and I can then reduce a gain that I have another part of the portfolio. And that way then like, oh, okay, I can back away from this and maybe make a good decision. The next one, and this was actually one of Danny Kahneman's favorite, which was representativeness. Okay, how do we represent different scenarios? So we'll start off with just a quick story or a quick scenario. So let's say Linda is 31 years old. She's single, outspoken, very bright, majored in philosophy. As a student, she was deeply concerned with issues of discrimination and social justice, also participated in anti-nuclear war demonstrations. So that's the scenario that's played out. So now we got to see which of these is most likely to be true, that Linda's a bank teller and is active in the feminist movement, or that Linda is a bank teller. Okay, so from representativeness, really what we would have the highest probability would be B, that she's a bank teller, right? Just because of what the scenario was in the past, we can't necessarily, and we do see this happening all the time. So representativeness will come in. And so this is kind of like how Kahneman would explain it. But again, when we judge the chance or the probability that some of that A is going to happen as being part of B, associating one with the other, sometimes will allow us to neglect information that is important to us. And so if we see this happening, we just have to be aware of it and kind of work through it. The fourth would be the concept of anchoring. Okay, anchoring. So what is anchoring? So anchoring is when we describe this tendency for us to rely on some initial piece of information when we make decisions. Okay, we are focusing on a number or a place, and then from there, we anchor on it. The best example I have was that a few years ago, my mother-in-law, she was gonna sell her home, and then we were gonna move her into an apartment. And when we got ready to make the decision, she was like, okay, I think we were trying to determine like, what do we put the house on the market for? $200,000. And we were like, okay, where did the $200,000 come? Just out of curiosity. It's like, well, because when I pay the mortgage off, then that leaves me with a balance of $100,000 equity. Like, okay, that's cool. And so then we're like, but that's not what the house is worth, but that's what we're going to put on the market for. So then we were like, so then she got anchored. So then we went out, we got an appraisal. Appraiser came in, said the value of the house is $185,000. And I was like, okay, good. We got the independent expert. And it's like the appraiser, I don't believe the appraiser. And it was like and so finally we put it on the market, and I think we ended up selling it for like 189, 4,000 above market. We're all high-fiving. And then she's like, I lost $11,000.
Wow.
And it's like, and it was anchoring. And we're like, and so finally it was like when the new place, it was like, well, if you go buy a new place, because in a way it was like, I felt like we lost 11,000, but it's like, well, what was the new place that you bought? And it was at that time where the markets were, housing prices were doing weird things. And it was only like, oh yeah, that's right. So I can buy it I can get like a cheaper price from someone else. And it was just this like, and we never could say, okay, what you anchored on was something that no one else in the market, no one else out there even knew you were anchoring on. And so we do this all the time. Cisco Systems. So there was this stock late 2000, in the late 1990s, Cisco Systems for a short period of time, most valuable stock on the in the market. One of my old coworkers, we were talking like in the early 2000s, and he goes, yeah, I bought Cisco System for like $80. Well, at that time it was 10. So I'm like, hey, what are you going to do with the stock? He goes, what do you mean, what am I going to do? I'm going to wait for it to get back up to 80. Well, just today, we were talking about this in class, and one student, I said, what's the price of Cisco? 50. So he's still holding because he anchored on that dollar. Like, I'm not selling. That's, I'm like, the only person who knows 80 is important is you, right? The market doesn't really care. So we do this all the time. So the fun things that can happen with anchoring is where we get out of investment. So here's an example where a researcher had done where they asked a group of people, hey, when Genghis Khan was in charge, Mongols ruled most of Central Asia before the leader led them on an ill-fated campaign into what is now Hungary, where he died. So answer the following questions. Did these events happen before or after AD 151? And then in what year did Genghis Khan die? Okay, so unless you're a history expert, we're like, I don't know, I'll come up with a guess. So if we were to kind of come up with a guess, the answer is 1227. So what does 151 have to do with anything? Nothing. The study person wanted to, I'm going to draw the anchor. So unless you knew, well, okay, I know Genghis Khan. If we did the same study and said, let's do 1,000, people's tendency of getting close to the number changes because unless we have an idea of this part of history, we're just making some, as best as we can, educated guesses. Another example is researchers would take a group, would take an audience, cut it in half, take one half and said, real quick, do this math in your head. 1, 2, 3, 4, 5, 6, 7, 8, 9, or to up to 8, come up with a guess. Then they would then go to the other side of the room and say, now, really quick, multiply this in your head, 8, 7, 6, 4, 3, 2, 1, and come up with a number. Now, unless someone is just a complete math wizard in their head, right? We're just coming up with a guess. Which of the two groups would have a higher guess? This group. Yeah, the one that started with 8. So they anchor off the bigger number. So their mind is immediately coming at a bigger number because we have to come up with what educated guesses as best as we can. Anchoring comes in. So it's almost like with negotiation, right? Sometimes the answer is like, who goes first? Well, the person who sometimes goes first can maybe anchor the price, and then you start discussing from it. Then if you get done going, how did we agree to that price? Because we started off negotiating, off wherever it was. So anchoring, so see it all the time. So when in doubt, check it out, having more knowledge, right? Sometimes we come up with these estimates of value and we're just coming up with a guess. And so sometimes we might need to just have some help. Or we just have to be humble. We just don't really know. The last one is overconfidence. Maybe think about it as confidence, but having too much confidence turning into overconfidence. And this is one, it's really fascinating because if you think about our evolution as a species going way back, how our brains were wired back when we were kind of, prehistoric man, someone had to take the confidence of like, I'm going to get out of the cave because there's food and the saber-toothed tiger is around the corner. Like, who's going to go do it, right? And so today, right, when people make decisions to start a business, maybe quit a job to go back to get a master's degree, you name it, get up, do a presentation into a large group of people, all these things, we need confidence to do it. Okay, that's great, right? That's how we can evolve. But when it comes to investing, sometimes this confidence can lead to overconfidence, which is like, I'm smarter than the market. I know where the market's going. And really, there's a small subset of people who can really do it. And so how do we know that this is out there? And then how do we try to kind of work through that? So we give an example of overconfidence. So how do you pronounce the capital of Kentucky? Is it Louisville or Louisville? How much are you willing to bet? And if someone's like, I know how it's pronounced, I'm from, I'm from the area. And then, well, the answer is Frankfurt. Right? So it has nothing to do with it. How overconfident you with that? Hey, I know I can pronounce it. One great example is in the late 1990s. Two professors from the University of California, Brad Barber and Terry O'Dean, they got hold of some Schwab trading data. Okay, so this was the time period where the day traders were running rampant, right? People be sitting in their rooms all day long. That was their job. I'm day trading. So they took the quarter of the clients who did the most trading, and they kind of made the assumption, okay, this is the group that are the day traders. So if they quit their job to day trade, they must kind of know what they're talking about. And then so they dissected the trades, and what they found out as a group, that the stocks that they sold a year later were up 3%. The stocks they bought were down almost 1%. Well, this isn't going right? I should be buying low, selling high, not the reverse of it. At the time, transaction costs were pretty expensive, almost 6% a year. So these investors lost as a group about 10% a year. And that's where they said that the central message of this research is that trading can be hazardous to your wealth. The more you trade, the more it can hurt you. So embrace the mistake. Keep a journal. So there's this podcast I listen to, Animal Spirits, and there's a couple of advisors, Ben Carlson and Michael Batnick. Younger advisors in their mid to late 30s. One of the two guys was at one point in his life kind of a do-it-yourself day trader. And so he fortunately kept a journal. And he would journal, like, what was my rationale from putting these trades on? Well, then they get on their podcast with the advent of time and experience. And every so often they'll pull it out and then they'll laugh. Like, oh, you're such an idiot. I was like, like 10 years ago, he was always trying to short Amazon. Amazon's overpriced. Here's my rationale. It was very well thought out. And then he got crushed over and over again. And it's like keeping a journal. And he said, this journal, every time I think I know, I go back to this journal, and this helps me to understand I really don't know. When we're trying to predict the future. So embrace the mistakes that we made in the past. Second thing is just get a second opinion. Whenever we think, well, I think I've solved this mousetrap, let me talk to someone else on this. And then sometimes we have to ignore the experts, right? We flip on CNBC. Someone thinks that they're, coming up with the latest opinion that it appears might be worthwhile or make some sense. Really, who is an expert, especially when it comes to the markets? So we'll kind of leave it with these biases. Hopefully, as we all kind of reflect on it, oftentimes we all fall guilty to all of these. We've probably seen them all in live in different situations that we've seen. But more than anything is like, okay, knowing this can help us maybe make, good decisions with our money. So I will stop there. I just threw some things into appendix at the end of the deck, and we can talk about this. We can talk about the markets. We can talk whatever is on anyone's mind.
All right, thank you so much.
You're welcome.
If you'd like to ask a question, please put your question in chat, or you may unmute and ask directly.
Funny stories. When I was back pre-Michigan State Day, I was chief investment officer at Citizens Bank. And so we had this one presentation called The Turbulence of the Markets. The whole illustration was no one really knows. Why do you make forecasts? So you do this presentation. Okay, we can poke fun of all the people who made forecasts. First question was usually, hey, what do you think the market's going to do next year? They're like, we're not being, why would I just said no one can do this. Sure, I'll give you my call. Yes.
I'm kind of curious. Do you think that if you go to see like a financial consultant or a stockbroker, do they try when they first meet you to try to figure out which of these traits you have? And then I think you sort of alluded to that. And then if they think you're risk averse, then try to give more conservative advice to you, or?
Yeah, so the question was that do I think that most financial advisors incorporate this into their practice? I would say the majority probably don't. I think it's in the back of the minds. I think even in back when I had lots of, probably not on the onboarding side, because you really don't know someone that well, unless someone comes in and they're like beating their chest like I'm the smartest person, but then they wouldn't be coming to you for advice. So that'd be the overconfidence one. I think it's more like over time where it would be like these little cues through conversation would be like the mental accounting one or the anchoring. I faced anchoring one all the time where we had, and it would happen with individual stock portfolios. And we'd be like, oh, let's sell this stock and this stock. And someone's like, oh, no, no, no. And it'd be like, well, why? And then you'd find out through conversation. All it helps, I think it helps us as the advisors to like, oh, this is why. Someone would anchor on something, or like my mother-in-law. I'm like, this is what's going on. Now, instead of like, how do I come up with other conversations? But I think we still have a lot to learn. And it's probably as we continue, I think sometimes what makes great advisors is where they will understand the markets and they understand financial planning, but they also understand psychology. And I think too many advisors probably don't know that third piece. Like, I'm faced with it, now I don't know why, So we're learning, we're collectively all learning, but it's probably, I think that's where the evolution's going, but we're certainly not there yet.
You mentioned the average investor. Warren Buffett's advice was the average investor should get into index funds and then go out and do what they want to do. And if you look at
Amen.
now, I retired in 2000. Well, I retired 13 years ago, and the Dow was 14,000. It's almost 2.5 times that amount now, even with that.
Yeah.
So that makes that point to be a long-term investor.
Yeah, I mean, that's just great advice that, and again, it was more of like a comment of Warren Buffett said that the average investor should buy an index fund and go on with their life and do other things that are more important than trying to chase the next stock. Awesome advice. Yeah, I'm a huge proponent. The interesting story is that the best story is that when I went through the picture, so Eugene Fama, the full father of efficient markets, index guy, okay? Everyone's rational. There's no bubbles. At the University of Chicago, the floor above him is Dick Thaler. Dick Thaler won a Nobel Prize for behavioral economics. And the two of them will argue and argue and argue. Investors are rational, investors aren't rational, blah, blah, blah. And at the end of the day, they arrive at the same thing. Like, well, okay, you guys can't agree with anything. How should the average investor invest? And both of them will say buy index funds. But they come to it for two different reasons. It's like, okay, whatever, if that's an interesting tug of war that you have. But yeah, for most people, that really makes the most sense. Yes.
I'm assuming that you inherit your attitude toward money from your parents and what you see. So I'm a very laissez-faire kind of investor. I just let my guy do the thing. And my sister's checking the market every day and whining that she lost $400. So where does that come from in terms of behavior?
Yeah, that is awesome. So there is this whole concept called money scripts. And it comes from our friends in psychology. And it's we know like where do we make decisions? So our environment, our upbringing, and then sometimes it's interesting. You and your sister, same house.
Right.
Why is one? And yeah, you'd have to, was there an investment decision somewhere along the line that might have been favorable for one or not favorable for another? Or would it be like, I'm just maybe my personality wise, just more like really antsy about things. And so that's another area in like personal financial advising where trying to understand, see in the old days, we would sit down and say, here's a risk tolerance questionnaire, 10 questions, fill it out. And this tells us how you should invest. And then we're on. And now we are just learning more and more about the backgrounds that people bring into it and why some are more cautious than others, and how do you create a because really at the end of the day, the key is how do we create a portfolio that the client is comfortable with, so that when the markets are going high, they don't want to buy, that they're not like going to get more aggressive, or unfortunately what happens more often when the markets take a tank, that they don't bail out. And so helping us understand that. Yeah, I don't have a good answer. But money scripts is a big thing. There's a professor, Brad Klontz, who kind of got his, he's a PhD in psychology, and he's bolted right in the industry and helping us learn on that front. So the social sciences and the, traditional stockbroker, there is like definitely a marriage that has to happen so that we can do a better job being advisors for people and for clients.
Emily, there's a question in the chat.
Yes, John how much better do trading algorithms perform if they factor in behavioral economics and cognitive biases? And if widely employed, how would such algorithms make crashes less likely?
That's a good question. I don't know. I know that when the literature started to come out of academia and then started to find its way into the practitioners, there were money managers that were trying to incorporate that. I know that what happens, and I remember, and this wouldn't be necessarily behavioral, but it would be more, let's say, algorithm, meaning like computer focus. Most firms, they can't let the computers just do the computers. Humans will intervene, and then it usually blows up. I'm sure there's firms out there, but I can't think of anything off the top of my head. And small is that there's this firm in Renaissance Technologies, which is out on Long Island. So Jim Simons, I mean, Warren Buffett, for his career has been able to generate like annualized returns of like 25%. Renaissance Technologies had funds that were doing 60%. And it was massive outperformance. Well, it's real money, but what happened was they found that it was not finance people, it was more computer science and physicists that would look for these small little inefficiencies and capture them. But they couldn't roll it out to everyone else. So who captured all this? It was the principals of the firm. So this is real money, but it was almost like kind of like taking the human out and letting the algorithm take over. But it didn't spill out to any of us. Just spilled out to the insiders. Which so there are those are ones that come to mind. But they're again, do they roll out to help us all? Fortunately, no.
Are there any other questions?
There are a number of large houses, so to speak, that provide advice, like Edward Jones or Fidelity, on and on. They have their own research components. And generally, the investors follow the information. Does that turn out to be good? In other words, best to take their advice or do your own investigation?
That's a great question. So a question would be, is that if I'm an advisor for one of the big firms, Merrill, Edward Jones, should I follow their advice? See, it's really hard. I'm very biased in this one, where I'm just like, I mean, the research is pretty. So in investing, there's these two competing schools of thought, which is passive investing, which is index, which basically says it is very, very hard to beat the market. So the academics would say when they run all of the calculations that it's impossible. And there's always then whenever you find exceptions, then people are like, so I look at it as like it's really hard to consistently beat the market. So you got passive camp. Then you got the active camp, which is hire me because I'm smarter than the market and I can. And a lot of advisors are still in the active camp and trying to have their clients follow that. And why? Why is that? Well, and really things are changing as we go on, but it used to be a lot of advisors, I make more money selling those products than I would a passive product, right? Vanguard's not going to pay me as the advisor, but Putnam funds would. So there's that part. So oftentimes I would say if I'm hiring an advisor, I'd be like, what's your investment philosophy? And then secondly, like, yeah, are we taking your research and we're always fiddling around with it? So there's almost like, philosophies of, do we tilt the portfolio all the time because you have a forecast? Like, okay, there's disruption going on in Europe because of Russia. Does that mean we make changes in the portfolio or not? Some advisors would say we're keeping our targets straight. Others are like, oh, let's make some calculated bets. Or they wouldn't describe it like that. It'd be more like we're going to be opportunistic. Code word for let's make some forecasts of how the future will play out. So I don't know if that answers your question exactly, or okay.
There's a question in the chat.
That might have gone directly to you, Marna, because I can't see it.
So sorry, let me read it to you, please. Are you familiar with IBD? And are you in favor of investing in very specific rules?
Okay, I'm not familiar with IBT.
IBD is an.
IBD? No. Sorry, I don't.
Okay.
So if that's a direct,
It's Investors Business Daily.
okay. Yeah. Yeah, I know that there are definitely some strong proponents. So Investor Business Daily generally will use like more technical analysis, and there's different rules. I think some advisors, sometimes it'll leak down to the advisors is more, sometimes the like individual investors may use it. I've heard those that believe very strongly have done well. I just think as across the board, as far as like implementing that, I guess I haven't seen it done widely successfully.
Another question in the chat. Michelle asks, do you think that emotions change investing choices with age?
That's a great question. Do emotions?
As you age.
Yeah. Boy, I don't have. I mean, you know what? The only thing that's I'm trying to as my brain is slowly trying to click through the files. You know, it's almost like from experience. I think it's interesting. So I'll go the other way. Remember years ago, Vanguard came in and they were talking about 401k accounts, and they went by age by deciles. Well, the most conservative investor, and this would be Vanguard across all their plans, all the plans that they administer, thousands of plans. The most conservative age group was the over 70s. Kind of made sense, right? I'm either right at retirement or I'm in retirement. Okay, that makes sense. And then as the age deciles got younger and younger, people got more and more aggressive until then the next most conservative age group were the 20-year-olds. And it was like, why? Vanguard would be like 20. You guys have like 40 years of runway, and they could not fit. And then finally it was like education, right? No one had they viewed it as like, wow, I put my $100 in and it went down 10%. I am out, I'm in cash. So I think that's not really the question about like, as we get older, I think the benefit probably as we get older is that we have maybe emotions might change a little bit, but we have so much more experience. And so I don't know. Does anyone agree or disagree with that? I guess I don't. There's probably research out on that. So we'll have to get our crack researchers digging into it.
Is the same true of risk tolerance?
I also don't know on that one either. I just find that and again, this is truly anecdotal. I'm just thinking of like clients or personal that, there are people that have always been comfortable in the markets, and as they age and you think, well, should we we'll use the word de-risk. So it's kind of a fancy way for, hey, let's have, let's put more money in the bond market. And I just think some people are either more comfortable, like, hey, I don't really have I think oftentimes people might get more conservative if the pool of money maybe starts to shrink and now it has to be more safer, then, if all things being equal, that, as time goes on.
One way to look at that, the way I look at it, is if I'm going to leave what I have to my son,
Mhm.
and he's fairly young, then I look at, or my granddaughters, I don't look at it.
So your time
necessarily.
horizon changes, right? Your
Correct.
time horizon all of a sudden says it's not my life.
horizon Can be as long
Yes.
as I think they can live.
And I think oftentimes that's where the perspective changes, right? Let's say if all of a sudden my nest egg is getting shrinking and I'm like, oh, I need this to support me. But if the nest egg is sufficient, it's like I'm thinking now multi-generational, and it can change. So that exactly, I think oftentimes that's what I hear from clients as they get older, depending on how their investment portfolios is, like, how am I viewing it? Well, outstanding. Well,
I have a lot, but
Oh, yeah, let's do it.
Do it.
Okay, if one is, if your broker calls you up and says, guess what? Amazon and Google are going to split. Now's a great time. You need to get in. So how does one react to these? I mean, do you then start doing your own research? I mean, this has happened to us recently because I believe Amazon and Google are going to split, correct?
Yeah, so here's the very, okay, I'm glad, that's a great question. I might not have an answer for you, but that's a great lead into the difference. Okay, so pure traditional finance would say is that if Amazon is $1,000, I don't even know what the stock price is. So let's say they split 10 for 1. So now they're going to be 100, instead of 1,000, then it's going to be, $100 or whatever the case might be. The market price isn't going to change because the pie is one size. However I cut up doesn't really matter. Okay, so they would say stock splits, no effect on the market. That's what Eugene Fama would say. But then we see that when this really does happen, the price does go up because investors. So why is that? So then that's where then the argument happens. Well, is it because people are saying now you allowed the cheaper price point has brought more interest in, or is it because I think I can, that the price will go up more, and I don't know if anyone really has an answer to that. But specifically on that one, I guess, I'm trying to think like Berkshire Hathaway trades at like $500,000 a share. All of a sudden Warren Buffett priced it down to like $25. Would I all of a sudden go, oh, let me do a little bit more research? So I guess it depends on, what do you look at, how much research you want to put into it. Oftentimes, Peter Lynch is a famous investor where he oftentimes bought by kind of like, what are things that are attracting attention,
I think there might be a psychology to this because I thought about it and I thought, I could buy 5 shares and it's going to split 20 for 1. I'll then have 100 shares.
Yeah.
Well, 100 shares sounds like a really nice
Yes.
number.
Yes.
Yeah? So that's some kind of, it's affecting my.
So it is the psychology of it. And so the two sides, or especially traditional finance would say has no impact, but we do know that prices move based on exactly, the psychology aspect of it, which is probably why companies do it. I mean, Warren Buffett had the opposite approach where he wanted a very specific clientele owning his stock, and he had no problems with it being priced that high. But other firms want lots of buying interest from lots of participants.
Is Morningstar a good source? Would you recommend other sources for investigation?
No, I think Morningstar is outstanding. So the question was about the quality of Morningstar. So Morningstar, Chicago-based firm, the de facto place to go for mutual fund research. The only thing that's interesting so we're probably all aware of the stars that Morningstar gives. 5-star funds being great, 1-star funds being run away from them. And Morningstar has over time done a better job. It's almost like the formula that they use to award the stars. But they've even done research and they were saying, okay, what is the best predictor of future returns when I look at a mutual fund? And so Morningstar they looked at every data item they had. And they were hoping the answer was going to be our 5-star funds. Buy a 5-star fund, Morningstar. And do you know what the single best predictor of future return is? Cost. Low cost. And then that was even more when that research came out. Then all of a sudden, like the index camp was like, now we have an explanation, So low cost. So John Bogle, one of the founder of Vanguard, was always a thing, keep costs low and let everything else follow. So that was interesting. That was interesting. When Morningstar came back, when that research came out, they're like, we were thought it was going to be our star ratings.
If you look at your students, when they graduate, what did they do? Where did they go?
Oh, great.
10 years from now, where are they?
Yeah, so today, I teach, so I'm the director of our financial planning and wealth management program. So I have students that so there's a group of students that are in our minor. So they want to be future financial advisors. And so those students primarily are going to go work for registered investment advisors and get a salary type position, be part of a team. A few of them will go and be traditional stockbrokers, where they enter a training room and they got to produce and, you know, try to make some money, which is good. I think for the industry, that's good. We want, you know.
Go ahead.
Okay. Then I have another group of students. I also teach our security analysis class, which is we manage $5 million of MSU money the students do. And so that group of students, they're either going to go work in the investment banks, New York or wherever, or they're going to go be asset managers, or they're going to do like corporate finance. So I kind of have students kind of sprinkling kind of all over in kind of the different areas of finance. So it's kind of interesting. They kind of seeing where so the investment banking kids, they go off, they spend 2 years at these banks, they work 100 hours a week, brutal, you know, and I'm like, why are you doing that to yourself? When I first started teaching in 2014, my TA, he went to go work for JP Morgan. And he said, oh, I'll stay in touch with you, Professor Schiestel. So I text him a few times, he would never text me back. And I'm like, man, this guy is like completely blowing me off. And then finally he goes, I was working so many hours, I literally could not respond to anyone. I'm like, okay, that's fine. I mean, you know, but it was funny because at that time, JP Morgan, Jamie Dimon, the CEO came up with this pencils down. Like, we know we're working you too hard, pencils down every Sunday. I'm like, how's pencils down working? He goes, it's 8. We're not putting any pencils down, maybe putting pencils down, but keeping the computers on. But, you know, but their object, those specific students are almost doing 2 years to go into do then. It's usually it's the opportunities to go do like private equity or hedge funds or any of that kind of work. So, but outside of those students, most of them kind of in theory, you know, assuming that they don't find something else they want to do, you know, maybe at that next stage of their career, you know, they'll do financial advising or corporate finance or something on that front. So it is fun. It is really fun watching them. Thankfully, we have LinkedIn, so I'm able to connect with them and I can just watch these students like, wow, they're really progressing along, you know. So it's great to see.
Good training.
Yeah.
We have more questions in the chat.
Okay.
Yes. Joe asks, well, or rather voices that he feels the market has become a casino where we are trying to outsmart everyone else short term versus being a place or a tool for capital markets to create funding mechanisms for creating businesses and real economic growth. And he's wondering if his view is too cynical because he would rather be an investor rather than a trader.
That is a great question. And I think it's something that it's really all over business, where the original question of what is like what's the role of the corporation, right? Is it to maximize shareholder wealth? What does that mean? And I have conversations. I also teach the BA program, and it's like, what exactly does that mean? You know, and then it goes into the marketplace. So there is no doubt there's a group of investors, large group of investors that are day traders, right? They're not really investors, they're speculators. But you know, if you are a long-term investor and finding long-term companies and your vantage point is long-term, I mean, you almost have to be able to say, I mean, I'm willing to invest in company A, whatever company A is. And I think they have great prospects and they have a good product. They understand their market, good management teams. And I'm going to invest in it today because I think 10 years from now, 5 years from now, it'll be favorable. And the winds of the market's going to shift this thing all around. And if my thesis is right, then I'll revisit it, or hopefully then in that 5 or 10 years it'll play out. So yeah, I can definitely see where there's a lot of investors with very, very short time horizons that are just creating a lot of noise that makes it hard for longer term investors to grow wealth, let's say over time, or companies to grow over time. So I'm with that, because that's my quick off the cuff synopsis of it.
Another question from John. How often are pundits' explanations for the sudden jumps or drops in the stock market accurate, and how often plausible but incorrect rationalizations?
Oh.
Relatedly, are there good studies of how well TV and newspaper pundits do in terms of their predictions? And do they ever get fired for being consistent wrong?
Okay, so I don't know if there is any real, let's say, like actual, let's say, academic research. I mean, there has to be somewhere, but boy, we've had so much fun over the years making fun of the quote unquote experts where you untangle their opinions. The two best ones we did, and these were golden. One was Jim Cramer. We all know Jim Cramer, right? So Jim Cramer, so this would have been trying to think of the time frame, March, April 2008. And he said, Bear Stearns is screaming by, back up the truck. Bam, a week later at zero. Okay. And so that was, okay, the market. And then another one, so Elaine Garzelli called the 1987 stock crash when she was the strategist at Lehman, or no, Shearson at Shearson. So she was like rock star, right? So for years, Elaine Garzelli talks, Wall Street Journal, listen. And then this would have been December 2007, going into 2008. She had a prognostication for the market. And it's funny, with the hindsight always makes it funny, like markets are going to be up 10%. They were down 50%. And the three stocks she pitched, I'm going off memory, was it was Fannie Mae, it was Merrill Lynch, and I think it was AIG. So Fannie Mae, government bailed out.
Right.
Merrill Lynch basically had to be auctioned off, and then AIG survived because we gave, the taxpayers gave them $180 billion. So yeah, the one thing is that if I'm on CNBC, Steve Schiestel, because I'm an expert, no one really, there's not like a track record. Not behind me is like, hey, this guy's been on 8 times. How well has he done? Stock pitch down, down, down. This guy's a knucklehead. Why is he here? Usually what CNBC wants is someone who can get on and is charismatic, entertaining, crisp message, and then hopefully we forget. So I think there was something, Steve Forbes, with the publisher for Forbes magazine, he would always say, we always hope that the memories of our lists or memories of our readers can't remember what was talked about in previous editions. So again, I'm sure by real good research that would say, yeah, most of these talking heads really are not really worth anything more than entertainment.
We have another question.
Oh yeah. Okay. Nancy asks, when the market goes down, do passive investors who have trusted algorithms investing at lower cost tend to move their portfolios to more active managers?
See, I don't know exactly. I would say, and then this is just kind of looking at fund flows. So flows would be mutual fund monies going in and out of funds. So DFA, Dimensional Fund Advisors, a completely passive shop. They would see when market volatility moves, there's not a lot of movement, which would kind of indicate that if markets dropped or their investors then moving into active. And in that world or in that fund shop, there's really no evidence of that. I think my take on it is that if I buy into passive, then I have to buy into the underlying idea, which is that very few people can really consistently beat the market. And so if I buy into it, whether the markets are going up or down, doesn't necessarily say there's always this talk that this is a stock picker's market. And I don't know when a stock picker's market is because it kind of depends, right? We don't know what it's, so in the last 5 years, every year, the Wall Street Journal say, this looks like it's gonna be a stock picker's market. And then when the year is done, 80% of managers can't beat the market. And it's like, I'm waiting for the stock picker's market to hit. So, there are the theory is that there are certain parts of the markets that are maybe they don't have as many market participants, so they're more inefficient. But then the research looks at it, and then it's hard to find advisors that will, or managers that can beat. And then there's always exceptions. I remember years ago, I had a student from Vietnam. And I think the question came up earlier about Investor Business Daily technical analysis. And he worked for the Vietnam stock market. And he goes, man, a lot of people make money off technical analysis. And it's like, my only kind of thought is that it's like an emerging market. There's not a lot of liquidity. There's only a certain number, and maybe then those rules work. But then as soon as money starts flowing in, good ideas get washed out.
Are there any other questions? I have a quick one.
Sure.
What's your take on cryptocurrency?
Oh, okay. See, this is one of these things where I step out on the ice, and the ice is, I have about that much
Right.
knowledge, and and I could plunge through. See, it's hard because I'm trying to get up to speed as much as I can. And originally we had this thought, and when I say we, some of my colleagues, not necessarily at Michigan State, but like former work colleagues and stuff. At first it was like, okay, is cryptocurrency, do we view cryptocurrency like dollars and yen and euros? And then in that case, there was a great Wall Street Journal article, and this was probably, this was a Fortune article written about 5 years ago. And this is when crypto, like Bitcoin, every year was going up. And they're like, if Bitcoin is going to start acting like a currency, the volatility has to way ratchet down. But then the people who are buying it are expecting huge gains. So then will those people say, oh, okay, if I'm getting like no returns, I'm out. So then they're like, I don't know how that plays out. And then that thesis never really played out, because then Bitcoin kind of kept going on and on. So then I think a lot of the proponents of it, they kind of changed the name a little bit, to like crypto assets. Like it's not a currency anymore, it's an asset. Like I have stocks, that's an asset. I have cash, that's an asset. I got bonds. Well, now create a sliver for crypto, which that might make more sense. And then the question is like, it's almost like gold. It's kind of like the same thing with gold. Like people that invest in gold. Some people have this theory that, there's gold bugs and there's like inflation if inflation starts running like we're experiencing today, do I want to invest in gold? So maybe that's the new place for crypto. So I still have a lot to learn on it. And right now I'm, you kind of say like, does the advantage of time and experience, is that give you tools? I think we all can agree on it. And then other times, like, do we say, well, this time is different or not? So I have a hard time. I keep going back to like, is this like internet stocks 1999, pets.com? And we know what happened to pets.com, right?
Mhm.
Or is this something new? And I don't want to be naive with it. So yeah, I'm trying to learn as much as I can. So I try not to have an opinion, because, I could go right through that ice real quick.
Understandable.
Yeah.
Anyone else?
Yep. Got one more.
As an individual investor, every year we get the chance to vote on who's on the board. And one of the things we get to vote on is an advisory vote on executive compensation. So we look that up, and then we find out that the person makes several hundred times what the average investor makes. Oh, isn't that awful? Where is that accountability ever going to be experienced? It seems to me that some of that money just ought to be pushed down into acquisition, investment, research, for the betterment of their employees.
Yeah.
And I don't know how that's ever, it's like the quarterback who makes millions. It's nuts.
Yeah. So great question outside of investments, but I think it's a great question about when we have to vote our proxies every year, and there's one about executive comp. So the executive comp piece, and I get a corporate
Steve,
governance expert.
Can you restate the question?
Yeah,
With
yes.
Somebody asking.
Yeah, so the question was corporate governance. So when we own individual stocks, and every year we have a proxy statement and we vote on executive compensation, why does this problem never get resolved, right? Corporate governance. So a lot of these votes that we take, I think they're advisory decisions where like the board is saying, we want to hear what the shareholders feel. And if the shareholders come in saying, we think it's too much, then the board would be like, thank you very much. Here's what we're going to do anyways. So corporate governance, it is a very, that's a very interesting topic. So one of the things that I've read or heard people talk about is that today in corporate America, we got these board of directors. One of the subcommittees of the board of directors is the comp committee. So the comp committee, they're responsible for setting pay for the CEO and the senior executives. So the comp committee then goes out and hires consultants to say, what are the other people earning? So that we can make sure we're fairly paying our, and then it's like this feedback loop. So the consultants, they want to keep their jobs. So they're like, hey, Mr. or Mrs. CEO, you get another $1 million raise this year. They're happy. The consultants stay in there, and it's this feedback loop. And almost like I've heard podcasts where people are railing on this, where they're like, we almost, to your point, the SEC has to say these have to be standing votes, right? That we get to vote on it, and you have to really take what we're saying into consideration. Or I don't know, it's almost like, do I take less to be CEO where, the next CEO over is making 10 million? Do I take 8 million and flush it down? Animal spirits come over, or do we have some way of limiting it? It's almost like, think however many years ago where they said that the deductibility for pay was set at $1 million. That will tamp it down. Well, then how do they, then all of a sudden stock options and restricted stock and bonuses. So that is a great question. I mean, to your point, you see some of these packages and you're like, holy smokes.
It's a self-fulfilling prophecy.
Yes.
Because they point to the guy next door.
That's exactly it. Yeah, it's like Matt Stafford gets $30 million a year. Next year, Aaron Rodgers gets, to your point with the quarterbacks. And each year it's like, well, I'm not judging off now. Now all of a sudden Matt Stafford's like, wait, I'm way underpaid. But to your point, yeah, like what the CEO makes to what the line, the entry level worker here in the United States, that is a major issue.
I do not see any more questions in the chat. Does anyone else have anything they want to add at this time? Well, let's all thank Dr. Schiestel for a wonderful.
Thank you. Thank you.
Thank you
Awesome
so much.
questions. Awesome questions.
That is great. And next week, we're back to the social sciences again. And we have Professor Ann Pegler Gordon from James Madison College with us, talking about exploring the hidden histories of Asian Americans. She's the author of a recent book, Closing the Golden Door: Asia, Migration, and the Hidden History of Exclusion at Ellis Island. Sounds great. Thank you, everybody, for joining us again for Town and Gown. Good night.
Good session.
Thank you. Thank you.
Great.